All right, what's up, guys? This is Bobby with Growth View again, and today I have our guest, Ekeh, and he's an entrepreneur and investor, and he wears a couple of hats. He's got a lot of talent, so I'm excited to have him here. He's the head of portfolio management at Kingstone Capital Partners, where he oversees over $250 million in equity assets, and he's also the founder at Rubicon Asset Management, where they just took down their first syndication. And not only that, he's also taken time outside of work to provide value. He's the co-host of Multifamily by the Slice, where he helps investors get started on their real estate journey to build their real estate empire and create wealth. So, Ike, man, thank you for joining us today.
Absolutely, absolutely, man. And I got to say, when you're in it, it doesn't seem like that much, but when you get a 30-second list of all the things that you've done in the recent past, you feel like you're doing a lot more. So thank you for that.
Yeah, man. Yeah, man. Glad we can connect. So what I'm really excited to talk about today, the topic we were kicking around before this was talking about illiquidity and how it's a key feature to real estate. And nowadays, like, we have this culture of just options trading has gotten popular, people jumping in and out of cryptos. We got NFTs, like everything's an investable asset now. It's been monetized. So I would love to dive into this and hear your thoughts on how the illiquidity of real estate is actually a feature and not a bug, and how it's a good thing.
Absolutely, absolutely. And I have a very unique perspective, at least I think so, on the topic because, like you mentioned before, I'm active on the equity side. So, your stocks and your bonds and ETFs and mutual funds. And I'm also active on the real estate side. So I get a nice mix of experience. And I can tell you that you should never treat the two the same. If you're looking for, a trading asset, most likely you look at your stocks and bonds. And if you're looking for a hard asset, you're looking for real estate and other, hard assets to hold. And the reason and the discussion we were having about illiquidity being a feature as opposed to a detriment to real estate, in my opinion, is the fact that it makes it much more difficult to exit a position emotionally. So for those of you out there that haven't gone through purchasing or selling a piece of real estate, you can't do it with the click of a button. You either have to reach out to a realtor or reach out to maybe a wholesaler, somebody that has a network they can tap in order to get your property listed and or sold on the market. And so all that takes time. Usually for, smaller real estate, your 1 to 4 units, that's 30 days. For your commercial property, that maybe 60 to 90 days, depending on, some of the inputs that go into that transaction. And during that time, you sort of, your emotional side takes a back seat to your intellectual side, and you start to really consider what it means to sell a property. And you don't have that feature with stocks and bonds. You can click a button and it'll be gone, and you can click another button and it'll be back in a second. Well, for those of us that have followed, investing for more than just a couple of years or, have made a career in it, and in fact, I actually recently shared a chart on Twitter that over the long term, real estate has gone up in value. If you look at the I think St. Louis Fed online, it'll show you a chart from around the 1920s till today. And yes, there have been blips of up and downs here and there, but the general trajectory of real estate has been up. So if you've held real estate for any meaningful amount of time over the last a few decades, you'll realize that your investment has gone up in value over time, and you most likely have benefited from it.
So I just pulled up that chart you shared. I want to kind of share this. I don't often share the screen in these, but I think this would be valuable. So here's the Twitter chart, I believe, that you shared here, right?
It is, yeah, that's it.
Yeah, so you can see over time how it's up and to the right. And like you said, timing real estate is difficult, but making money by timing the market is nearly impossible. Dollar cost averaging the cash flowing real estate is the way to go. And I agree to this 100%. One of the statistics I personally heard, I think Fidelity did a study in the last couple of years, and the best investors were people who forgot their password or they died. And it's kind of ironic, and it really aligns with what you're saying, and it's true. Like, we've kind of gamified everything. Like, one thing, Robinhood recently, it's gotten really popular. You do a trade and like confetti falls, and we've really gamified and kind of like overstimulated investing, where the smartest thing you can do is buy and hold, not get emotional about it. And I love how you brought up the point, you kind of have to sleep on it. It takes 30, 60 days. You can't just act on emotion.
Yeah, and there's a very timely example for the listening audience. We're recording this on May 3rd, 2022. Berkshire Hathaway, one of the largest companies in the S&P 500, ran by Warren Buffett and Charlie Munger. They recently had their annual meeting on Saturday, the 1st, I believe, or the 30th. And on during that meeting, they were talking about Robinhood and how that was making the stock market into a casino. And the fact that all those bells and whistles that are features or characteristics of that app make it seem like making a transaction is the good part about investing, where in reality the transaction should probably be the most stressful part, and the part that actually adds value is what you do to the holding after the fact, whether it be for a public company adding to your position when others are selling, or if you have a large enough position like an Elon Musk, taking control of the board or taking control of the company itself, and
Yeah.
adding value in that way. For real estate, it's the same thing. When you're buying or selling the property, or let me say, when you're buying the property, they always say you make your money on the buy. Reason people say that is because you should be buying a property that you can add value to and subsequently reap the value of if you plan on sell or recapitalize with a refinance or what have you. And so going back to the Warren Buffett example, I looked at a chart of Berkshire Hathaway over, I believe, the last 5 years in comparison to a chart of Cathie Wood's fund. I don't know if you're familiar with Cathie Wood.
Yeah.
And you'll see that, yeah, 3 years ago, Cathie Wood was, really outperforming Berkshire Hathaway. But I think a few weeks ago, Berkshire Hathaway actually took the lead. And that's after being maybe 50 to 100% below where she was. And that just shows that long-term mindset that Warren Buffett and his cohort have held for, longer than we've been alive in combined, has really done well for him, done well for his investors, and also done very well for his portfolio companies, knowing that their investor, the money that is in their company is going to be there through thick and thin, and it allows them to operate accordingly.
Yeah, no, that's a great point. Cathie Wood's been like highly admired and one of the better performers, but a lot of these tech stocks have recently taken a pretty big hit. And when I was on Multifamily by the Slice, I brought up Bitcoin and its unique role in a portfolio. And I think for me, like holding Bitcoin, that's another thing. If you hold it for over 4 years, you've never been down. That's one of the things. It's a long-term thing, and that's what we always try to talk to people about. Those of us who are in Bitcoin is you don't get in and out of it. You hold it. Otherwise, you end up with less. And it's kind of the same thing with trading. Like you end up with less if you're always going in and out. You got tax consequence, all these complicated things. And Warren's proven to be right. And you raise a great point. Like buying and holding and adding to the position when there's quote unquote blood in the streets is better. The
Absolutely.
volatility in some of the tech's crazy. Now, let's get back to real estate, like some of the illiquidity, like talk about some of maybe the incentives and just things that are on the real estate side that are very good, maybe that someone who's listening who has been investing in options or equities, like maybe they don't know about real estate. What are some of the great things that you love about real estate and its illiquidity that makes it such a powerful tool in your portfolio?
Sure. Well, so the comparison with real estate and stocks, illiquidity is a massive part of it, but it even goes beyond that. In stocks, how do you make your money? You make it in appreciation, right? Or maybe possibly dividends, quarterly dividends, or monthly dividends if it's a REIT, that you get from your share of X company. In real estate, you get the appreciation similar to stocks. You get probably larger dividends because you're getting cash flow from rents, but you also get tax write-offs from the expenses of the property, not to mention the depreciation that you can get from on an accelerated standpoint, or just a straight line depreciation if that's what you choose as well. So those are components that are not attributed to stocks that you get in real estate. And to answer your question in regards to illiquidity, well, from a tax perspective, the government and the IRS are trying to incentivize people to hold real estate longer or hold any asset longer, because if you hold an asset for 366 days and then sell it, then it becomes a capex gain, right? Or it becomes a capital return as opposed to ordinary income. So with that being the case, and I actually just experienced this recently, I bought a duplex in Cleveland February last year, and I held it until March this year and sold it, as opposed to selling it prior to that February period this year. And my tax on that is going to be much less because I held it for more than a year. So holding something long term is gives you an advantage from a tax perspective, as well as the illiquidity, making you make more rational, less emotional decisions.
Yeah, I agree. I've kind of done that too. As like whenever I buy anything, I want to try to hold a minimum of a year because that tax number is just way too big. It's way too big. Now, are you able to, because you're a real estate professional, are you working over 700 hours or that line in the sand where you can start to get some of these additional write-offs with some of the deals you're doing, whether it be in your syndication portfolio or your personal portfolio?
So as well, at least in my own head, I'm a real estate professional because I spend a good amount of time on it. But according to the IRS, even if I was spending those 700 hours, on real estate, which I believe at this point I am, because I have a full-time W-2 job, there's simply no way they'll allow me to be considered a real estate professional. That said, those bonus depreciation is what I think you're referring to.
Yeah.
Those depreciation paper losses, if you cannot offset them with capital gains from other investments in year one, they still roll over to the following year. So you'll still be able to take advantage of them. You simply can't take advantage of them for your ordinary income. In a perfect world, I would be making enough from real estate to tell my employer, hey, pay me $1 a year and I'll take the rest in capital gains. But until then, I'm still subject to the rules of being a non-real estate professional.
Right on. I had to ask your opinion because I had a guest who said it's kind of gray, and while they have another job, they do real estate at the same time, and they kind of talk to your own tax professional. I guess that's the word, guys. See where that line in the sand is for you.
Well, yeah, cool. I'm sure that there is some give and take there, especially if you're married to a real estate professional or the company that you're working for as a W-2 is in the real estate space. But again, for me personally, it doesn't work. Not yet, but maybe when I come on the show in a couple of years, we'll have a different story to tell.
Yeah. Well, no, that's perfect. And kind of a complimentary question, like with the illiquidity of real estate, it's a get rich slowly game, not a get rich quick game. And I'm sure you're familiar with Wall Street Bets on Reddit, that subreddit that's gotten so popular. I joined that in 2018. I've kind of watched it, had some fun back in the day, but seen some dark things happen, like just this gambling culture. Like, what is it like when you're in the real investment management world with like suits and hanging out with people who know how to allocate capital and manage it? Like, what impact has that had in your industry? What type of conversations are people having? And like, to just tell me about that, the culture behind that.
Yeah. I mean, it's funny. It's funny. And by the way, let me get back to what you mentioned in that, real estate is a get rich slow, as opposed to, options trading or, some derivative stuff, getting rich quickly. Grant Cardone, I'm sure you're familiar with him, had a very funny, sort of tongue in cheek line. And it's great marketing for real estate investing, by the way. He said, real estate or gambling in the markets is get rich quick. Real estate is get rich for sure. Right. So like, it's just a matter of time. If you're investing in real estate, you're going to be rich eventually. Right. So I just wanted to add that because I thought that was funny. In regards to some of like the Wall Street bets and like the GameStop stuff that was going on last year, because we have clients that aren't necessarily in the investment world on a day-to-day basis and following these things, when something like that comes into pop culture, they reach out and we discuss it with them and sort of tell them why we wouldn't do something like that or why we would do something like that. So I got to be honest with you, that's the extent to which, at least my firm got involved in any of that. It was just sort of educating clients as to why we wouldn't get involved into that sort of thing.
Yeah.
But one of the things that we like to say, because we try to model our firm after Berkshire Hathaway with Warren Buffett, is that we always look at it as if we're buying a share of a business as opposed to buying a stock. And I know that is sort of splitting hairs and, you know, just playing around with words. But when you change your mind to think, okay, I'm going to buy this business called Apple because they have X amount of earnings and they've shown X amount of growth over the last, you know, few quarters, and they have this much cash on their balance sheet and their debt profile is X, almost as if I'm looking to buy a piece of real estate that it has a cap rate currently of X that possibly can have a cap rate if we do Y and Z, and, you know, we're getting debt at X level. So if you look at things like that, you're much, notice I didn't say price in any of that. I was talking about the metric, the internal metrics of the company or the piece of real estate.
Yeah.
And if you look at investment that way, you tend to, again, turn on that intellectual side of your brain, as opposed to seeing, okay, Apple's trading at 100 now. It was trading at 95 yesterday. Wow, it's probably going to go to 105 tomorrow. If you think like that, you're thinking more emotionally. But when you're starting to look at what's under the hood, what changes you can make to a piece of real estate, or what the market is gifting you in the pullback of a stock price, then you're starting to use that intellectual side and are more likely to invest in it as if it's a business and hold it and manage it as if it's a business.
Yeah. And it kind of raises the question to me, like, I know there's ways you can leverage your equity portfolio, maybe take out loans against it. I feel like that's more common for institutions, maybe not for individuals. But what I love about real estate is just, you know, a normal person is you can actually take leverage, and there's playbooks all over the internet that teaches you how to use leverage. Like, you can go to a local credit union, refinance, and, you know, take advantage of your real estate portfolio. Tell us a little bit about how leverage impacts real estate, and can you take leverage against the equity portfolio just as a individual investor, like how that might work between the two.
Sure. So, and it's something that's become, you know, popular more recently with lower interest rates, or probably change with interest rates increasing. But there's a concept called pledged asset accounts, where you can pledge assets in an equity account, a brokerage account, and take out a loan against those assets. Obviously, LTVs play a factor in, the amount of capital, you know, the balance of the loan factors in, all those things factor in. But you can take loans against assets in an equity account. But here's the thing, you have to have the assets in there to take a loan against it. So say I have $1 million in an equity account that's invested in a bunch of blue chip stuff that, you know, is not going to go up and down, like GameStop or any of those stuff, any of those stocks. You can take, you know, a 50% LTV or 60% LTV against those assets, but that's after the assets are already in the account. It's already funded. It's already invested. With real estate, you can take a loan to buy assets, right? So I can go say, oh, so the same valuation, $1 million piece of real estate. I don't have to go give the bank $1 million in order to take a loan out to buy that. I can come with 200 or 250K and get a loan for the rest to buy that asset. And that difference is important for many reasons. Your return on equity will likely be much higher, given the fact that your equities piece is much smaller, a much smaller portion of the full capital stack of that deal. And just to take that a little farther, so your equity in that margin loan in your pledged asset account is effectively 100%, because you put all of the money in and then took a loan against it. Whereas with the real estate deal, your equity is either 20 or 25%, because you're borrowing money in order to fund the purchase of the deal. So the return is going to be stronger on the real estate side. And B, when you go to do your depreciation or bonus depreciation, that is based off the asset's value, not the amount of equity you put into the deal. So theoretically, if I were to find a way to buy that $1 million deal with $0 down, I can still take depreciation, so a paper loss against my income, according to that $1 million asset price. So that is a very powerful tool for those that utilize bonus depreciation, because you're able to pull that depreciation out, take it up against your income without actually putting any real dollars into the deal, or a minimal amount of real dollars into the deal.
Yeah. Yeah, that should be super compelling for people, where if you can paint the picture of the reach that your portfolio can have if you use it in the right way with leverage versus just putting it into equities. And then the volatility right now has me kind of scared. I'm personally not in equities. I'm just in real estate and Bitcoin, but I love real estate and just the optionality it gives you, and just it's just an incredible tool. That's great. Now, when it comes to your podcast, Multifamily by the Slice, I had a chance to chat with Dre, and I love his passion to like help and serve others. And I know you work hand in hand with him with yours guys podcast. Tell me a little bit about how that's been going, and just some of the future things and the mission of the podcast that you guys have been working on.
Bobby, it's been a blur. It's been an absolute blur. I mean, you were on the show for those in the audience, episode 2, I believe you were on our show. And to give you the full story on it. So I met Dre here at a meetup downtown here in San Diego. And we got to talking. We're both investors, both relatively young guys. And he was like, "Hey, you know what? I would love to have you on my show. I'm starting a podcast." I'm like, "Sure, I've never done before, but you seem like a cool guy. We already have a good rapport. I'm not worried about it being weird or anything like that." So I'm like, "All right, let's do it." And so we record the show, and afterwards he says, "Hey, look," afterwards I said, "This is really cool. I've always wanted to start a show." And he was like, "Look, I haven't launched this thing yet. If you want to jump on as a co-host, it's up to you." I told him I would take a day to think about it, and then 10 minutes later I text him like, "All right, let's do it." So that was November last year, 2021. And since then, we launched it. We were dropping 2 episodes a week for the launch period for a couple of months, and we had some incredible guests, including yourself, on the show, and we met a lot of people, did a lot of networking. And in terms of the response, I went into it thinking, there are a million podcasts out there. It's a noisy space. I'm relatively new in the real estate space in terms of assets under management or raising capital, anything like that. So I may not have the most value to provide, but it's at least a great networking tool for me, where I can meet guests. I can tell people about my show and yada yada yada. But it's been far and away, it just exceeded everything I thought it would be up until this point. Because yes, we've been able to meet a lot of interesting people and have them on the show. Yes, I've been able to sort of spread the word here locally and also across the nation about the show, and have people listen in, and people reach out to me and say, "Hey, that was pretty cool." But if I always get the updates for reviews that people leave on the show, and some people it's crazy how people are touched by what we're doing and spreading the message about an asset class that is little known, even though it's the most prevalent asset class on the planet. People are reaching out and saying, "Hey, the way you guys explain things on your show, and the guests talk about what they've done and their stories, it's really motivated me to really delve into it." And I've DMs from Facebook, Instagram, text message, everything. People asking me, "How can I get into this? Can you mentor me?" And I feel honored to be put into that position, because I did not think even 6 months ago that I would be someone that others look to for advice on real estate investing. But here we are. And also we've gotten a couple of sponsors, and we agreed that we're going to donate the vast majority of whatever we make going forward from the podcast to charity. And that's just another way to give back, because honestly, I've gotten more from the podcast than I thought I'd ever would. So it's all house money at this point.
That's awesome. No, I love it. Yeah, I remember the first time interacting with you guys, I could just sense like a servant leadership heart, wanting to give back to others. And I mean, you're obviously busy. I know, like with Rubicon, you just closed your first syndication, so you're definitely carving out time in your schedule to not only like do your deals, but like to help others along the way. And it's just incredible to see. I mean, I just love it. And that's one thing for me personally. There's always like this kind of secret or esoteric knowledge you don't know unless someone is willing to pour into your life and share. So anytime I meet someone who's just willing to take that time and educate others, that means a lot to me. So I'm glad we can be able to speak with you more on it here.
Yeah, and just to sort of add a little bit to that, a mentor of mine told me, and I've heard this many other places, that the person that gives the most wants for nothing. And that's basically means, if you focus more on providing value to others, people will want to take care of you. People will want to help you in your time of need. People will want to, seek out that next person in their network that could possibly help you grow your business, or, anything like that. So, having that go giver mentality, you can even be, if you're a selfish person, keep on giving a lot and you'll get even more in return. Like, having the go giver mentality, it's really changed my life. And I want to sort of spread that message out to others, because the net of everyone having a go giver mentality is that people will want to give back to you, and they'll prop you up in your times of need and when your momentum is going. So um, if there's any one message to take away from this discussion, I would say, when someone asks you for anything or people ask for advice, try your best to answer it or point them in the right direction, because chances are at some point down the line, you're going to need something and they'll be more than willing to help you.
That's great advice. Go giver, not a go getter, a go giver. That's the word, man. I
Yes,
love
sir.
it.
Yes, sir.
Well, let's talk a little bit about Rubicon. I know you're the founder of Rubicon Asset Management, and you just closed your first syndication. What's that process been like? What all have you learned? Tell us about the deal and break it down.
Oh man, a lot, a lot, a lot. So, um, probably around August, September last year. Well, let me give you a little bit of my history in real estate. I started essentially in 2018. I bought a fourplex out in Phoenix, Arizona, and I basically had a crash course in real estate over the course of about 6 months there, because I bought it distressed. Had some pretty rough tenants in there. It was in bad shape. Had a lot of deferred maintenance. I didn't know anything. I'd read a bunch of Bigger Pockets book, and probably listened to 1,000 hours with the podcast, but I guarantee you're gonna find some stuff on your first deal that did not come in any of those books. You just got to go for it, right? So I went for it. I went from everything from dealing with evictions to having to jackhammer through a kitchen floor to get to a broken pipe. All of that, like all the worst you could think of, I was there. And so, I it went well ultimately, and I was able to refinance that, and that's what I used to buy the property I mentioned earlier in Cleveland. And from there, and that was last year. And from there, I realized through networking, through finding mentors, that real estate's a team sport. And if you want to go big in real estate, you got to get good people around you. You got to increase your network, and you got to think big. So I joined a mentoring group. I learned the tricks of the trade in multifamily, and decided to just hit the ground running. I reached out to a couple of guys that had a deal under contract out in Clarksville, Tennessee, which is a suburb of Nashville, Tennessee, about 40 minutes northwest of Nashville, Tennessee, right on the Kentucky border. And they agreed to allow my firm, Rubicon Asset Management, to partner with them on the deal that they'd already gotten under contract. The caveat was I had a certain amount of money I had to bring to the table, and I had to agree to become an asset manager and take on the role, at least a portion of the role of the asset management team. And so, similar to a lot of other things in my life, I just said yes, and I'll figure it out later. And I was able to. It was quite the capital raise period. I can tell you, I didn't have a massive network. I probably had a few people that I figured, okay, maybe these guys will be interested in investing. And so I really hit the pavement. I really tapped my network, and did I man, I probably had 40, 50 Zoom calls over the course of about a month, um, to explain the deal, explain what a syndication is, explain what to expect, the risks, the rewards, and I was able to get it done. And so I became a partner on that deal, and we actually just had our first distribution yesterday, which encompassed December of last year because we closed around Thanksgiving and Q1 of 2022. So yeah, you want me to go into the deal as well, like deal specifics and all that stuff?
Yeah, yeah. Now that you framed it, kind of your background and taken down your first one, tell us some of the details about it. What makes it a good deal?
Yeah, so it's a 39 unit Class A build in Clarksville, Tennessee, like I mentioned before. It was built in 2017, so not a ton of maintenance, unlike my first deal, right? So that was already a plus. But the opportunity is that we were buying it from the developer, and he was optimizing for occupancy. So he kept the rents extremely low, and wasn't keeping up with the market, and therefore wasn't keeping up with the operations of the property. He was one of those guys that he said, okay, if a light goes out in your unit, let me come and fix it. I don't want you touching anything, or
Oh man.
that's sort of a hands-on
Yeah.
kind of guy, like mom and pop essentially, right? So it was a mom and pop deal. So we went in and we fixed some of the operational detriments of the property. There was a little bit of capex here and there, but not anything that was monumental. And we went in and started the process of tidying it up a little bit from a functional and operational standpoint, and getting the rents closer to market. And by doing so, we're going to be able to add what I think is a couple of $1 million in value to the property. And then we're eventually going to refinance a portion of the equity out of the deal, and give that back to our investors, hold it a few more years, and most likely sell it to the next guy.
That's awesome. And the deal that was in Phoenix that you kind of got bit deep with your teeth into for your very first one. Are you still holding that?
So I am. I bought it in 2018. I still currently own that deal, but funny enough, I am driving out to Phoenix tomorrow, my fiance and myself, and we're gonna meet with my broker, go clean the property, get some photos taken, and it's gonna go right up there on the MLS.
Nice,
Yeah.
nice. Right on.
And I can give you a little bit more on that decision because I actually recently made it. And the as many of your listeners probably know, the market in Phoenix is absolutely insane.
Yeah.
The appreciation there, the rent growth there has been just bonkers. And I did some math again. So leading back to our previous discussion about thinking emotionally versus rationally or intellectually, I did the math, and currently my return on equity, so the return on my equity position in that deal, is around 4.5%, which, by itself isn't great. But if you consider the fact that I've already refinanced out all of my initial capital and it's still appreciated to the point where my equity only yields that much, it's good from that standpoint. That said, if I were to refinance with today's rates and what I expect the rates to be, in a few months when I do refinance, my return on equity will still be sub 10. I'll get some cash out, obviously, but the return on equity is still be sub 10. And the way I see it, I still expect, rent growth in Phoenix. I still expect net migration to be strong. I still expect values to go up, after, over the next few years. I can't tell you with my crystal ball exactly when it's going to stop, but chances are it's still going to keep on going up. But the way I see it, from when I started to now, I've done pretty well with this property. And since it's a fourplex, the valuation is wholly determinant on the value of the property around it. So I say that to say that I can only do so much as the operator to add value to the property. And in my opinion, I've done all I can. So my goal is to sell it, take that equity, and put that into a property that's 5 units or more, where it's valued not only by the relative value of its local economy, but also by the income that it brings in, so that I am in a position where I have the determination of whether I add value to that property or I don't.
Yeah. That's a great point, and that's what really attracted me to syndications. I was like you, listened to probably 1,000 hours of Bigger Pockets. Was like, I need to dive in. After I dove into my first two rentals, I listened to enough, and everyone said, I wish I got into syndication sooner because it's
Yep,
based on net operating income,
exactly.
not comps. And where we are now, I know we have a shortage of houses. I know rates are high, but your strategy, I agree with. Like getting into assets that operate based on net operating income is a bit more resilient, and it makes holding illiquid assets. It makes me even more confident in them because who knows what's going to happen in the public markets. But
Exactly.
to these commercial assets, there's a lot more resiliency to them. And I forget the number in 08 or 09, but I think the default rate was less than 1%, where residential, it was far higher. I don't know the exact number off the top of my head, but there was a commanding difference between the two.
Yeah, and the reason why is because in that time, and look, I was 18 in undergrad during then, so I'm obviously no expert, but from what I've looked back at through my studies and through work in that time, the reason why people were defaulting on their loans, those residential loans, is not necessarily because they weren't making payments. It was because they were in what's called technical default, where the valuation of the property had dropped so much that the property value was at or below the balance of the loan on the property. The people could still make the payments. They, were still fine to continue the lifestyle where they had it. But according to the bank, they were now underwater. Therefore, the bank called those loans due.
Like a
That doesn't
variable you can't control.
exactly, and that's the idea of control. And that sort of thing doesn't happen when your value is being the value of your property is determined by its income. Yeah, the property value may go down a bit, but when a bank sends out an appraiser to reassess the value, they're also going to consider the fact that your income is effectively the same, therefore the property value is effectively the same. You didn't have that opportunity in residential, 1 to 4 unit properties, because even if it had income, that's not considered in the value in the appraisal for the loan.
Yeah. Yeah, no, you're spot on. One of the things about syndication I find really interesting, because I subscribe to all these syndicators, get every email, every single one will say cash on cash, 5 to 8, the IRR, 15 to 21. And I scratch my head and I say, all of them are the exact same. And there's kind of this cultural minimum people want to meet, but oftentimes you exceed it because you do conservative underwriting. And that's
Yep.
where it pays to be, talented at reading, underwriting, and being able to interpret deals. But that's also what's beautiful about multifamily is if you can take into consideration these extraneous variables and risks you can't control and assume worst case scenarios, you can still beat the return of the S&P, which people love to measure, 10% a year, 12% since the 50s. But there's even more incentives aligned with it. And that's the beauty of a liquid real estate.
Yeah. Yeah. And I can tell you, I mean, I was probably one of those guys who sent you an email saying that, we have X IR or X cash on cash. And it's funny, during the time where I was raising capital for that deal that we did in Clarksville, one of the people, or it was actually an investment group that I was pitching the deal to, they told me that the IRR that I was telling them was too low. They said that we only invest in deals that are X IRR or higher, and in my head I was thinking, okay, you do realize that all these numbers are basically made up. Like, there's just assumptions based on rent growth, based on cap rate, whatever. They're the best guess of the person who is presenting it to you. So I mean, I'll say that internally, but externally, I just told them, look, this is our a conservative assumption for the deal. If this doesn't hit your mark, that's totally fine. This deal is not for you. But I'm not comfortable, just juicing the numbers for the sake of raising capital, right? So there's a give and take and a happy medium with the IRR discussion. But for those of you out there that maybe haven't, looked at a ton of different deals and underwrote them yourself, and this is the same on the equity side too, because you have your discounted cash flow, which is essentially the underwriting for a public company, and the vast majority of the purchase price or the stock price that you end up with after you discount the cash flows is based on revenue growth expectation. So you can pretty much put anything in an Excel spreadsheet and get what you want, right? So for those of you that haven't necessarily, underwritten a ton of deals, just understand that the inputs that go into a underwriting model are far and away more important than the outputs, right? So the IRR is great to look at, but I want to see how you got to that IRR. And for those of you that are going to be pitching deals, make sure that you have a reasonable case behind the inputs of your underwriting, because it's much better to turn down someone or to turn away somebody that doesn't think your numbers are strong enough than to take money from somebody who expects your numbers to be too strong and then you can't produce.
Yeah, this is really important. And this is a conversation I'm having with a buddy who just offloaded a substantial amount of single family. He's starting to get into his first syndications, and his metric is kind of like, hey, I want to hit this IRR number. But the thing I've noticed is if you look at the numbers that syndicators say, because they're being conservative, oftentimes the numbers when they exit the deal are better. And there's an organization I invested with, and they hit our 5-year return in 2 years. And I was excited. And they said, hey, we found a great way to invest this still within the 5-year time frame where we think we can hit that metric again. And I was thrilled to hear that, So I think it's a rare skill set, I think, for people to be talented and to take the time to learn to read into underwriting and understanding markets. And I think that's what separates GPs from LPs. But as an LP, you need to have a good understanding of how to read that stuff, because that can make or break your investment, especially for a first-time investor. So I think that's a great thing. Maybe if we could dig in another time, like how to do that, because I love your perspective, how you're a GP, but you're also an LP, and sounds like in a couple of deals potentially too. Maybe that could be something we talk about, but that's probably one of the biggest takeaways I think a young investor needs to level up on, including myself. I leverage friends like Jeremy, our underwriter at Growthview. I just don't like the numbers. I'm a deal chaser. I love sales, but it's just a very important talent, especially in this market, I think.
And and that's another reason why I enjoy the multifamily and the commercial investment space at large. It's because you don't actually need to know everything, right? Like you can leverage those around you, leverage people in your network, leverage your partners on a deal to get the full group ahead. Like 1 + 1 = 3 in real estate, right? So like even if you're out there and you don't necessarily understand the Excel spreadsheets and underwriting behind deals and don't have the time or don't have the want to learn it, as long as you team up or invest with, as an LP, people that you can trust, or people that have delivered before, or people that have a track record that is more important to them than any amount of money that you could give them, then you're most likely going to be in good hands. And that's why, they always say real estate's a team sport, because if I'm, genius guy that knows underwriting, that knows asset management, that knows capital raising, that knows everything about real estate, you that's really good at simply capital raising, but can also network to find all those other parts, are going to do much better than me, because you have a group that can divide and conquer. Whereas I'm a one-man shop trying to do everything by myself, moving super slow and super inefficient.
Yeah. No, I agree. I left the digital marketing agency I worked at for 10 years, and now I'm a part of 3 to 4 businesses, but only due to having a team am I able to do it. I tell people what I do, and it's a mouthful kind of at the beginning when I shared what you do, and you're like, man, hearing this is, we're accomplishing some things. And I feel the same way as you express it to someone, and they're like, you're doing so much. And it's like, I'm not doing too much.
Yeah, I'm not doing all of it.
I have a team, and it makes it fun. You're surrounded by great people you can trust, you can build a lifestyle with, and you can serve others. And that's
and it's a lot more fun that way. I can tell you that the moment one of my investors texts me like, hey, I just got that email, that our distribution is coming out. That's awesome. That moment feels better to me than anything that I personally got by myself, because it allowed me to sort of fast track somebody else into what it's like to have that true passive income from real estate. And I mean, being able to celebrate your wins with others is much, much more important, at least in my opinion, than the win itself. Because no one wants to hit a hole in one by themselves on a golf course. Like, you want to be you want to be with your buddies and celebrate it afterwards. So that's just the way I see it.
Yeah. No, I love it, man. There's so much I'd love to talk about more. I know we're limited with time. I respect your time and I appreciate you being here. But I got some of these details. I'll put them in the show notes, but just let people know where they can connect with you if they wanted to just reach out and talk more.
Absolutely, absolutely. All my handles on social are a form of my name. I think my Instagram is IKEEKEH_. On Twitter, I'm IKEEKEH. On LinkedIn, just search my name, IKE space EKEH, to check out our podcast. That's www.multifamilybytheslice.com. We're on all the platforms, so you can find us pretty much everywhere. To check out my company, RubiconCRE.com. If you want to sign up for my newsletter, I put one out monthly, and I also have a quarterly newsletter as well. So those are the best ways to reach me. But give me a call or a text, 415-290-2713. More than willing to chat, more than willing to talk about real estate. And lastly, my email is ike@rubiconcre.com. So if you can't reach me now, I can't really help you.
Yeah, you better get off the struggle bus. Great, man. Well, hey, I've appreciated it. Thank you so much for coming on again. It's been a pleasure.